Welcome to CrushTheStreet.com's weekly market wrap-up. Let's start things off in the equity sector, which was surprisingly mixed on the first day of the government reopening. The S&P 500 rocketed to a new record height of 1733 points, while the Dow Jones ended up flat against its prior session, closing at 15,371, a level that is 2% lower than its record peak. Since the December 2012 bottom, the Dow is up 19%, while the S&P is up nearly 24% over the same time period. While such divergences are not necessarily bearish in and of themselves, the split behavior is noteworthy given the instability of the current market environment. This is perhaps best reflected by the jobs report. Between 2008 and 2010, the economy lost a net total of 7.6 million jobs. From January of 2011 until August of 2013, 5.7 million jobs were created, leaving a deficit of 1.9 million that will need to be filled in order to regain nominal equilibrium. Of course, there is a huge difference between nominal basis and contextual basis. While the current administration loves to tote the recovery rhetoric, the bottom line is these jobs are merely seasonal, low-paying positions in tightly margined industries. A hiring spurt at Taco Bell will simply not get the country back on its feet again, and even such qualitatively gross distortions will not provide enough meat for the government to paper over its problems. And the real problem here is deflation. I understand that there's a lot of talk about inflation, but let's use some logic here. What do you get when you have less workers in the workforce making substantially less wages? That's right, deflation. This is economics 101 in its most rudimentary form. Less demand means more supply, and therefore prices have to come down to adjust accordingly. Of course, the Fed understands this loud and clear. The chairman, or should I say chairwoman, is forced to keep taper off the table for as long as humanly possible. This will certainly be a big boost for gold and other precious metals. The spike up in the yellow metal to reclaim the $1,300 mark is likely the first shot of many to come, at least until 2014. The credibility to the United States and its underlying economy has been severely damaged, and that will continue to pressure the dollar. More downside to the dollar should mean more upside for gold. And no, this time a rally should be serious. None of this peekaboo crap. Gold has had ample opportunity to be obliterated completely, but it has held firm on key technical levels, and that is significant going into a traditionally strong season for the metals. Also, strong movements in the euro and the sterling pound suggest that more investors are getting concerned about safe haven assets. In that case, a risk tolerance for bullion, despite its complete lack of passive earnings, should increase under this environment. Also be on the lookout for strong upside moves for platinum and palladium, as their extreme rarity and weakness in the dollar should provide a fundamental boost towards their spot valuation. And that will do it for us. Thanks for watching, and we'll see you next week.